Hi, this is Ryan Urban with Alpha Financial, and today we'll take a quick look at the retirement income planning process. Now, what we're going to do here is an exercise that I do for both business owners and for non-business owners. We're going to lay out the retirement income planning process for you, and we'll include the eventual sale of your business. Now, for many business owners, their business is their retirement plan. Now, while we want it to play an important role in our retirement income, putting all of our eggs into one basket can be a risky proposition. So if you at all possibly can, you want to be contributing to your retirement plan while you are also running your business and allowing the equity in your business to increase. Here are the steps that we take when we meet with business owners and engage in the retirement income planning process. Now, we use several data inputs, including anticipated years before retirement, your ages at retirement, the anticipated after-tax proceeds from the sale of your business, anticipated Social Security benefits, which oftentimes surprises people, anticipated retirement plan balance based on current contributions, any pensions, and then any other net income such as real estate. And then we incorporate what's known as the 5% rule, and we will get into that for you very briefly. So here's an example. Bob and Susan are each 56 years old. They plan on selling their business in 10 years. They've established a plan using an ESOP, an employee stock ownership plan, and a cash value life policy to receive a lump sum for the business. Now, do understand that leaving a business, in fact, we go over this in the business exit planning video. When you leave a business, one mistake that some business owners make is they think that they're necessarily going to get just a lump sum for their business. That may not always be the case. But for this, we'll say that they are going to receive proceeds from the sale of the business at about $800,000. That's after taxes and after all fees. Their total current balances in the retirement accounts equal $432,000. They're making $6,000 annual contributions. And they're being conservative and anticipating a 5% annual return on their investments for the next 10 years. That would leave them with a nest egg balance in 10 years of a little under $800,000. Now, that is their retirement plan only. That is not their the money from the sale of their business. Next, we're going to use the 5% rule to estimate their retirement income based on their nest egg and the net proceeds from the sale of their business. Here is how the 5% rule works. When someone comes to me with their retirement nest egg, a lump sum, they want two things. First, they want retirement income, and then secondly, they don't want to outlive it. That's our biggest fear, as a matter of fact, when we're in retirement, is that we're going to outlive our retirement savings. So what we do then is we invest that money for what we anticipate to be about a 5.5% long-term return. Now, that is not risky. It's moderate at best, but even when you're in retirement, you need to put some money at risk so that it grows and keeps up with inflation at least. Then, while that money is growing at about 5.5% over time, which is our anticipation, they take out 5% annually with maybe 3% annual COLAs, cost of living increases. So there you go. The 5.5% is essentially replenishing what they're taking out. And the beauty of that is that the principal, what we want the principal to do is remain the same. And it's not unusual for that principal to grow, even though you're taking that money out, because hopefully the nest egg is growing at a higher clip than 5%. So that's the 5% rule. So based on that, your business proceeds for this couple, $800,000, 5% rule, $40,000 a year or $33.33 a month. Your nest egg proceeds just a little under $800,000, $39,569 a year or $32.97 a month. Now, what we're going to do is use these figures in our income planning process. And let's begin with the husband here. He's the business owner. He's 10 years from retirement. His income anticipated $33.33 from his post-tax business sale. Here's the big surprise a lot of people get, and that is their Social Security benefits at age 66. People, first of all, yes, Social Security will most likely be there, so I just didn't go ahead and make that assumption. People are often surprised by the amount of the Social Security they're going to receive in retirement. So if a guy or a woman has worked for a long time and made a pretty good income, $2,700 a month at age 66 is not out of the question. Then his retirement plan balance income based on the 5% rule, $3,297. No other income, that gives him a total income personally of $93.33. Then his wife will say that she worked some. She has a Social Security benefit at age 66 at $1,700 a month. From her old job, she'll get an $800 monthly pension, and she has a retirement or an income-producing real estate property where she nets about $200 a month average, and that gives her about a $2,700 a month income. So beginning with age 66, based on what we're doing right now, they would be looking at a total income of about $12,000. Now, there are a couple of caveats here. Number one, when we do the income planning process, we also include the effects of inflation. And then number two, there will be increases between both Social Security and the retirement nest egg income to try to keep up with inflation after they begin taking their retirement income. So that is the retirement income planning process for business owners. And of course, we can help. Alpha Financial can assist with the wide range of issues that face business owners. You can find us online at alpha4business.com, and you can reach me directly at 719-659-9190. We can work together in person or online. Thanks for joining us.